yeah, it takes sometimes an external shock to cause a really major recession. If no such external shock comes, the Fed can slow down the economy to the level that people would call kind of a soft landing. The problem is it's very hard to engineer a soft landing. You can bring the plane down, and then something happens in the very last bit right before you hit the runway, and all of a sudden it's not so soft anymore.
Welcome to The Ripple Effect, the podcast that takes you on a journey through the minds of Wharton faculty. I'm your host, Dan Loney, and in each episode, we'll be diving deep into the inspiration behind the groundbreaking research that Wharton professors have conducted and exploring how their findings resonate with the world today.
Well, the question of recession is one that's been in our vocabulary quite a bit in recent months, but whether or not we see it occur is still a big question. Will it be short and somewhat painless, or will it have a little bit more teeth to it? Nick Roussanov is a professor of finance here at the Wharton School and joins us to look at the concept of recession, what we've seen historically and what we could be seeing down the road. Hey, Nick, great to talk to you again. Thanks for your time.
Hi, Dan. Thanks for having me. Always a pleasure. Always enjoy talking to you.
Thank you. So the idea of recession, obviously right now, there's speculation that is out there, but it seems like it feels like it's a little bit of a moving target right now, that we don't really have, all the data that would say yes or all the data that would say no at this point.
Absolutely. And if you look at some of the key indicators of a recession, like the unemployment rate, it's still near historic lows. It has only ticked up a tiny bit, but it's still under 4%. So basically the levels that we saw pre-pandemic. So talking about recession when the labor market is kind of hot, the unemployment low, labor force participation rising, still not quite at pre-pandemic level, but nearly. It seems strange on the one hand. On the other hand, of course, there is all this talk of a recession. Why? Well, because the Fed is raising rates. And there's kind of an old adage that says that recessions don't replace expansions by themselves. Expansions don't die of old age. The Fed kills them. And this is kind of what I think everybody is anticipating, as with the increase in inflation that we saw, the big wave of inflation, the Fed trying to fight it, raising rates, and that's what kills the expansion and brings the recession about. So far, we have not seen it. The signs of an economic slowdown are really, really tiny compared to the signs of a kind of a healthy economy chugging along. Of course, the markets get jitters every time that they think that the Fed is going to tighten more than has been previously expected. And yes, there may be some pockets of weakness here and there. Talks of a commercial real estate collapse are quite active. But so far, the key indicators of a recessionary environment that have to do at least with the labor market are not there.
Historically, when you think about recession, in air quotes, there's usually some sort of shock that really kind of sets up the concept or the actual recession from occurring when you look back at history, correct?
Yes. Again, yes and no based on what I just said about the Fed's role. The Fed can slow an economy down, and then typically something comes along that sort of breaks with that Fed tightening. So in 2007, that was the housing market that really kind of broke, and then the financial system way kind of went down with it and really accelerated the collapse. And of course, with the most recent recession, the Fed started tightening, but there were really no signs of a meaningful recession until all of a sudden the pandemic hit, and that, of course, had nothing to do with the Fed or the financial markets or anything that the U.S. consumers could have done. So, yeah, it takes sometimes an external shock to cause a really major recession. If no such external shock comes, the Fed can slow down the economy to the level that people would call kind of a soft landing. The problem is it's very hard to engineer a soft landing. You can bring the plane down, and then something happens in the very last bit right before you hit the runway, and all of a sudden it's not so soft anymore. I think that's kind of what happened in 2008. And of course, you can't blame the Fed for 2020. But in 2008 and 2001, sort of a soft landing. Yeah, it was a recession, but it was a fairly short, fairly painless, you could say, recession after the kind of the collapse of the dot-com bubble. Of course, there was another external shock there, 9/11.
Yeah.
But really that was kind of a regular recession.
So how important is it when these events occur and you're looking at all of the dynamics at play? How important is it to look at each one of them individually and not, or is it important to kind of look at all of them as a group to kind of understand what was in play, and maybe there are things that correlate between different recessions?
Absolutely. So financial economists in particular like to look at the shape of the yield curve. And we see that when the short-term treasury yields are above long-term yields, that generally is not a good sign going forward for the economy.
Right.
And in fact, that is probably one indicator that has consistently predicted a recession in the next year to 2 years. It's not a particularly precise indicator, and that's because the long-term treasury yields, long-term rates, they incorporate investors' expectations about the future, what's going to happen to the economy, not just in the next year or two, but in the next decade or 2 decades. And so one reason the long-term yields might be lower than the short-term yields today is that investors expect both lower inflation and lower growth than we've had in the recent kind of post-pandemic couple of years. But another reason that's often brought up is that while investors expect the Fed start cutting rates once a recession actually is on the horizon, or actually is with us, it's a little bit self-referential, because if we said that long rates are lower than short rates because investors expect the Fed to cut in response to a recession, that suggests that they know that the recession is coming. So it's not like a very useful indicator if it relies on people expecting a recession. Nevertheless, it has been true for the last several decades that whenever the yield curve, quote unquote, inverts, again with short rates higher than long rates, soon something happens, maybe because the Fed over tightens or something else that makes a recession kind of transpire.
But we've been in that kind of a cycle now for several months, where the short-term bonds have been riding quite a bit higher with yields than the longer-term bonds. And I think, is that the main driver as to why people are continuing to say, okay, this has got to be coming, this is going to be around the corner?
I think that is an important driver. Maybe not the only driver, but certainly the fact that the Fed has tightened and might continue tightening, even though they might pause for a little bit. Right now, the consensus is that they will not tighten at the next meeting, but it's still not off the table that there will be another hike if inflation kind of rear its head again. And in fact, as we saw, the latest inflation print yesterday came in higher than expected, a little bit higher, not a lot. A lot of it was oil, true. Some of it was shelter, which is in core, which is what the Fed watches. So it's possible that the inflation has not been conquered yet, and if that's the case, Fed might tighten again, and that'll invert the curve even further, kind of steepen the inversion, which means people will say, well, now they're about to break it. But as you said, we've had this talk for several months.
Yeah,
it can take a year, maybe even a year and a half. In the past, we've seen these inversions predict a recession a year to 2 years down the road. So it's not kind of a precise science that the second you have an inversion, a recession is going to happen. It's an indicator that the Fed is tightening sufficiently that investors don't think such rates are sustainable for a long time.
Are we at a point right now, it seems like that November, at least from a lot of the conversation out there, will most likely see a rate increase. But the speculation also is that we've pretty much hit the top end, or we're very close to the top end on the Fed raising rates at this point. Is that where you think we kind of are right now?
I think so, unless we really see inflation heat up again out of not nowhere, but out of the combination of, oil prices going up as they are with the tightening supply constraints. The slowdown in China could further hurt supply chains, and the whole supply chain worries might resurface, sort of a cost channel. So it is possible. It doesn't seem likely to me. I think the likeliest outcome is that 6% maybe the top for the Fed or thereabouts, and whether that happens in the November meeting or later on, that's probably the likeliest outcome. But you never know.
So you go back to 2007, and obviously, as you said before, there were probably some actionable things that could have been done at that point that, could they have prevented what occurred at that period of time if changes had been made and different policy had been followed?
It's hard to tell. There is a lot of debate about what happened in 2007, 2008, let alone what should have been done and
Sure.
what could have been done to prevent it, because of course the housing buildup happened over several years prior to the recession. We saw a massive expansion of household balance sheets, mostly because of borrowing via mortgages. Cash out refinancing was at historically high levels. But obviously, lots of fragility was also built into the financial system. I'm not going to go through a whole list of things that we have debated.
We could be here for an hour talking about that.
Exactly. But it's not something that could have been solved easily and quickly. And I think Bernanke should be given credit for trying to do the best he could. I think. To contain the crisis. Maybe some of the signs of the financial crisis could have been spotted sooner, and some of the fragility in the financial system could have been identified. But it's always easy to say that in hindsight. So, by the way, speaking of mortgages and mortgage refinancing and cash out, one of the topics that I love to research. The second kind of highest peak of mortgage cash out refinancing happened just a few quarters ago. And so we've had house prices again at historic highs, and households are taking advantage of that, even with mortgage rates rising. In fact, the only people refinancing mortgages in the last few months, given that the rates skyrocketed, are people who are taking out a lot of cash out of their homes. The question is, what is that going to do to balance sheets of these households when the tightening finally breaks the housing market? And we haven't seen a big pullback on house prices. It's maybe some regional pullbacks, but not at a national level. And what happens then?
When you're talking about, though, man-made circumstances that are kind of in and around and leading up to a recession, does that tend, when you're looking back at it, to kind of spur kind of more of a regulatory kind of viewpoint and push to try and prevent what occurred and try and lay a framework so that we don't ever have to deal with that scenario again?
Absolutely. But I feel like what we see every time is that, the generals always fight the past war. The regulators, they always fight the past crisis. So, we saw the stress test that the Fed used to test the bank's ability to withstand a crisis did not consider possibility of a rate hike. They only considered the possibility of recession and a rate cut. So all this stuff that we saw in the spring with SVB and First Republic, the regional bank crisis, could have been perhaps avoided if the stress test, the SVB was not subject to a stress test. It was too small. But if the kind of regulatory apparatus paid attention to the fact that if rates go up, which they will have to if we see inflation, a lot of these banks that have loaded up on long maturity treasuries will be in trouble as they have been. So I feel like there's always kind of a past lesson to be learned. But whenever you learn the past lesson, you often forget the lessons that came before that, and you kind of have to take a broader view of what kind of things that could happen, and there will never be a repeat of what we saw in the past. It'll be something different.
So would it be fair or unfair of me to ask you to get your crystal ball out right now and look at where we are right now with all of these dynamics at play and what you think we may see play out over the next 6 to 12 months?
Well, I can always speculate. It would be unfair to go anywhere further than that. But I think the commercial real estate sector, I'm not an expert on, but from what I understand, is in a bit of trouble. And when that starts hitting the lenders' balance sheets, we might see issues there, and it's going to be potentially on top of what we've seen so far with this treasury maturity mismatch, with liability mismatch with assets. But there could be other things. Certainly, geopolitical issues don't go away. The war in Ukraine is going on, and OPEC is restricting oil supplies. So oil prices are continuing to climb. The U.S. shale is not able to respond like it did in the past, either due to kind of ESG capital tightening, or just the fact that the labor market is super tight, so it's hard to get workers. I don't know which one is kind of the dominant constraint, but so far we have not seen expansion in oil drilling in the shale patch nearly as much as I would have expected, given where prices are kind of going, or where they went. By the way, at the start of the war, they came down quickly, but now we're at the point where the Strategic Petroleum Reserve is as kind of at a record low, and at the same time, it's small relative to what's the amount of oil that the U.S. economy needs anyway, but we don't see kind of a massive increase in U.S. drilling, which I would have expected as a kind of response to the oil price rises. So the fact that oil prices are rising may not necessarily spill over into high inflation, as some people think it might. But it's not good for the U.S. economy when it's restricted on its supply side, when it's restricted in its ability to produce more oil. High oil prices are good for Texas when Texas can drill, but when it doesn't have the capital to do so or the workers to do so, it's not good news for anyone.
I'll finish on this because it seems like obviously we go through recessions every X amount of years, and the dynamics in many cases are different because of what they've occurred. So from that perspective, the understanding and the learning from each of these different recessions is just as important as the last, maybe for a little bit of a different reason or a different impact, but it's still the learning part of it is exceptionally important.
Absolutely. And certainly the fragility of the financial system is now a lot more at the forefront of monetary policymakers than it was before the financial crisis.
Yeah.
And rightly so, perhaps. And again, we don't know what exactly is going to break, but it's quite possible that something different will break in financial markets this time compared to what happened in the past. So certainly we should learn the lessons from the past, but we shouldn't kind of forget that there's lots of lessons that we've had historically. We should take the broad view and also consider things that perhaps are outside of that historical experience as well.
Nick, great to talk to you, and thanks for your insight.
Thank you. Always a pleasure.
You got it. Nick Roussanov of the Wharton School.
Thank you for listening to The Ripple Effect. We hope you found this episode informative and engaging. Don't forget to subscribe and leave us a review so that we can continue to bring you the best insight from the Wharton School.